Hello, everybody, and welcome back. Today, my guest is Edmund Goh. Edmund is the head of China fixed income at Aberdeen. Welcome, Edmund.
Hey, thanks for inviting me, Thomas.
Edmund, today we want to discuss recent developments in the China fixed income market. So, the sentiment in the Chinese bond market is currently heavily weighted down by the Evergrande case. What is the impact of this event?
The default of Evergrande is a pretty significant event in China because it was the largest property developer in China, and it has an outstanding debt of close to 150 billion US dollars and total liabilities of close to 300 billion. So it is a pretty significant company that has gone under in a couple of weeks ago. I think what the market is worried about is the systemic risk that follows, not just on the Evergrande default itself, because since Evergrande default, we have seen other smaller names that have defaulted. I think another common name that people would know would be Fantasia, that has also defaulted in early October. It's worrying, but Aberdeen believes that the property market is significant enough for the Chinese economy. And we don't think the government, the policymakers in China would allow the spillover effect to affect the entire economy as well as the growth. So we think there will be some easing policies that will be rolled out soon to contain, the risk that comes from the Evergrande default.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. Many international investors are afraid of some kind of Chinese Lehman moment. So how has international demand for Asian bonds evolved since the middle of the year?
I think we have heard concerns from our investors and some, friends from the press. But if you look at the statistics, if you focus on the net flows into dollar Chinese bonds or into the renminbi bonds, you can see that there's actually more interest and there's continuous inflow despite all these worries that we talk about, whether it is property market, whether it is abrupt policy changes in education and healthcare sector. But I think people focus on the long-term prospects of the Chinese economy and the Chinese market. And most people are willing to look past this shorter-term risk and continue to invest in China because they do expect a pretty positive and pretty attractive return that you can get from the market.
We've seen record interest rates for Chinese junk bonds recently. So to what extent have default probabilities increased?
If you look at how much the high yield bond credit spread has moved in the past couple of weeks since Evergrande default, that is really significant because based on memory, I think about 20% of the property issuers in the dollar market, probably more than 20%, they yield above 20% annualized yield now. So there's a huge amount of default risk being priced into the market. We think the market has definitely overreacted recently. It is the right time to think about adding risk in China. I think it is overdone, and it is hard to foresee Chinese property default in that kind of rate that's being priced in to the market now. We think a correction in the market would be pretty imminent.
What are the prospects for Chinese bonds in the current situation, and where do you see investment opportunities?
We are still positive on Chinese interest rates. If you look at where the Chinese government bonds are trading compared to most of their counterparts in the developed markets, we are still talking about 100 to 200 basis points difference in yield, and that makes China very attractive. And don't forget that unlike a large part of most of the other parts of the world whereby they are battling inflation, China's inflation has relatively been pretty low and pretty contained, even though we saw higher commodity prices. And we believe that PBOC is they probably have a higher propensity to cut interest rates rather than hike rates. And that is also something that is unique to China, because for most of the other markets that we are watching now, they are under pressure to hike rates. So the trajectory for Chinese interest rate is actually lower, but for most of the other markets, they are under pressure. So that is for the interest rate market. And of course, in terms of credit, that we do see overreaction in the market due to the recent default cases. And there are very attractive opportunities in some parts of the credit market. And we think the yield is very high now. Definitely a good time to look at it.
So that's interesting. So the market is currently speculating on higher interest rates in the US at the end of this year. So, and you think the spread between the US interest rates and the Chinese interest rates will be even higher?
Yeah, I think one common question that we get, the spread between US and China used to be really wide. And will that still hold going forward? Because US rates have to move higher while the Chinese rates have to move lower. Our view on this topic is that there is enough buffer between the US and the Chinese interest rates for them to go opposite way. I do not think that they will converge anytime soon. It is hard for me to foresee US running a 3% interest rate and Chinese, it's unlikely for them to meet anytime soon. And one thing that concerns PBOC is maintaining a reasonably prudent monetary policy. So while we think that they are going to cut interest rate, it is unlikely that they will move very abruptly and in huge magnitude in their interest rate cuts.
So we're already coming to the end of the year. So what is your outlook for China bonds for 2022 currently?
For 2022, we do expect that PBOC will have to deliver a couple of rates cuts. And we are not talking just about triple R cuts. We are also predicting that they would have to cut MLF. We think growth is going to disappoint in 2022, and it is likely going to undershoot most of the economists' expectations. It could go sub 4% next year. I think people overestimate how much the policymakers care about achieving high growth. I think they are willing to tolerate a lower growth. They are, of course, to support the economy, they would deliver some rate cuts, but it would be done in a very slow and gradual manner. But that is enough to support the Chinese bond yield. We think that the trajectory is definitely for the yields to go lower in a gradual way.
So given that scenario, what do you think about Chinese credit for the next year?
Yeah, so for year 2022, we are still positive on Chinese credit, especially on dollar Chinese credit. The reason why we say that is because if you compare the credit spread between the Chinese dollar credit market and the renminbi market, on average, you do get around maybe 100 to 200 basis points higher in credit spread for similar rated papers. And we think that is really attractive. We think the selling of the Chinese credit bonds in the dollar market has been a lot more aggressive than in the renminbi market, which present more favorable entry levels now for investors in the dollar Chinese credit market. So I guess in terms of positioning, going into next year, we think that there are probably more opportunities to exploit in the Chinese credit dollar market. Yeah.
This was Edmund Goh, Head of China Fixed Income at Aberdeen. Thank you very much, Edmund, for being with us today and sharing those interesting insights.
Thank you, Thomas. Enjoy being here.